Hello everyone, welcome back to Upside Down Data. Today I want to talk about some macro considerations that I'm keeping in mind as we go into 2022 that I think might help shape whether or not 2022 is a bullish or a bearish time for crypto. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So there are several things that I want to talk about in this video, and the first thing I want to talk about is just some things internal to crypto itself and kind of where I see the macro picture for Bitcoin, and then move into some things that kind of go beyond the crypto markets. So the first kind of thesis or idea that I want to put out here is that in my own personal opinion, I don't think there's anything internal to crypto currently that's suggesting that we have to go into a bear market or at least a protracted bear market. I personally don't see anything that I'm seeing that seems especially worrying or that says we have to be doing that in the upcoming year. And there's several different pieces of data that we can look at that might kind of help us shape this view. So the one indicator that we talk about on this channel, more recently introduced indicator, is the momentum bias indicator for Bitcoin. And, you know, Bitcoin being kind of the barometer for the health of the crypto markets generally. You know, when Bitcoin's doing well, the rest of the market tends to do well. When Bitcoin's doing poorly, the rest of the market tends to do poorly. Understanding the momentum in the Bitcoin market can be useful in a more macro sense. So essentially what this indicator picks up on is the propensity for bias to be moving in the upside or the downside in a given moment. So 0 corresponds to the average level of bias that Bitcoin has had throughout its history. And as you can see with this positive price trajectory, that momentum has been positive. There's been more up than down overall. And so what you want to see is momentum bias hanging out more in the positive side than the negative side during a bull market. And if you see the momentum bias hanging out a lot more to the downside than the upside, you know, below 0 more than above 0, that tends to be when Bitcoin will go through these bear markets, these downtrends in the market. So, you know, we saw that coming off the peak in 2013 into the bear market before the run into 2017. You see the momentum bias is hanging out a lot more below 0 than it is above. Same thing with 2018 going into 2019. But really what we're seeing right now is not so much that. We're actually seeing behavior that's a little bit more reminiscent of these past moves to the upside, this kind of oscillation around 0. And I've talked about this before when we talk about this indicator. This kind of equal oscillation around 0 tends to actually kind of emerge during these rallies, during these uptrends. And, you know, we are in an uptrend. We're seeing behavior that's totally consistent with that, and it seems like it could very well continue. There's nothing I'm seeing here that says that we're going into a bear market. You know, a really bearish sign would be if we keep moving up here, get rejected off of 0, for example, then spend more time down here. That would be when a bear market might be more plausible from this this indicator, or maybe more likely from this indicator. What we're seeing right now, though, doesn't seem to be deviating from what we've seen from past moves to the upside. So there's nothing I'm seeing here that says that this is not necessarily pointing to any problems right now, basically, is what I want to say. The momentum bias is hanging around, it's oscillating around where Bitcoin tends to hang out on average, which is positive, so that's good. That means we could expect price appreciation as long as momentum bias tends to hang around that level. And then if we get into these higher degrees of momentum bias, that might mean that we're building up to a parabolic run that tends to shoot up to the upside. Another indicator that we can look at is, of course, the upside downside potential indicator, you know, our risk model that we have here at Upside Down Data, kind of our flagship indicator that we look at. And really what this indicator gets at is risk. You know, at a given point in time, is you know, the risk reward ratio favorable or unfavorable for acquiring Bitcoin. So 5 being high risk, -5 low risk. And here I just have the price history of Bitcoin plotted with each day being a dot, color-coded the output of the UDPI. What you can see is that we had this really low-risk point in the summer, kind of this mini bear market, and then a nice rally off of that, and we've actually hit green again at a higher price level. You know, we're sitting up in the mid to high 40Ks, and the risk is falling down to the green zone that we haven't seen since Bitcoin was down in the 30K region. And that's a good sign. I think that's the model thinks that there's, you know, less downside potential to be realized essentially up here, or the price at which we might be realizing that downside potential should be higher than what it was thinking here. You know, it thought that further moves to the downside were possible down here, Here, we're already at green, and so any moves to the downside will just move us even deeper into this territory, and it might be kind of unlikely for us to push much past where we were in the summer. Now, anything could happen, who knows, and the model updates, it's a smart model, it learns from what it's seeing, and it'll be updating as it sees more price action. But currently, it's not thinking that extreme moves to the downside are especially likely. We could see moves to the downside, but it's unlikely we're going to revisit, 10K, for example, which is what some people think is going to happen to Bitcoin in the near future. I think we're going to this protracted bear market. From the perspective of the UDPI, that just doesn't seem especially likely. Anything can happen, but from this model, it seems unlikely that we're going to be seeing something like that. Now, another data point that I think is kind of useful for more short-term kind of interpretation, short to kind of mid-term macro interpretation of what's going on, is the Fear and Greed Index. So Look into Bitcoin is a great resource for a lot of different data science models or charts. So it's definitely one worth looking at if you want to see some more of those. And they recently added one for the Fear and Greed Index, and I think it's just interesting to look at because you can see, and Joe put out a video recently where he talked about this as well, but really with the Fear and Greed Index, it's trying to tap sentiment in the market. Are we in this especially kind of greedy sentiment period or really fearful sentiment period? And what you'll see is that really when you get into these extremes, extreme fear or extreme greed, that tends to correspond with either local tops or local bottoms. And so if you're in extreme greed, that can be kind of when you're in the middle of a parabolic run. Extreme fear tends to be when you're kind of at the depths of a bear market, and you might be able to expect a bounce. And here you'll see that we're pretty low on the Fear and Greed Index. We're pretty fearful in the market generally. And that, ironically, is actually a bullish sign. The more fearful the market is, the more likely you might be to the bottom. Now, again, anything could happen. We've seen before that you can stay in extreme fear for a while and still have capitulations to the downside. But oftentimes these low levels, these extreme fear points, tend to mark kind of bottoming out points. And we've seen that, recently with the summer being very fearful, leading into a more greedy time. It's in kind of September, early fall. And then we had a fearful time then later on September into a greedy period, going into November, and then now we're back into fear. Totally possible we see a reversal of the upside going back into greed territory from this perspective. Now, of course, nothing's guaranteed. We'll have to wait and see what happens. But from this perspective, you'd certainly rather be kind of in this zone at this decrease in price than in more positive sentiment, which might mean that we have further move to the downside from this perspective. So also some on-chain data I think is interesting to look at when we think about the health of the crypto market. And one of the things that tends to happen with Bitcoin throughout its cycles is that if you look at the long-term holders, so there's different ways of quantifying long-term holders. Glassnode has their own definitions they tend to use. Here, one way we can think about it is this kind of one-year HODL wave, and that's essentially Bitcoin that hasn't moved in a year, so Bitcoin that's been held for at least a year. And you look at spending of that coin, and the idea is that people are just holding on to Bitcoin for over a year. That actually tends to correspond to when you're in less risky times in the market, kind of more low points, accumulation zones. And you'll see this throughout Bitcoin's history, that when Bitcoin's going up to a top, that tends to be when people have been spending coins, so there are fewer coins that haven't moved in a year. So declining values on this means that there's just fewer coins that haven't moved in at least a year. So the idea is that older coins are being spent, they're being distributed as we get to these tops. We saw it again here in 2017, and we saw it again here in the spring, where people were selling older coins, getting out of the market, leading into the crash that we saw in May. What you'll see is that the trend's actually reversing. So now there are more coins that are at least a year old than there were back in the summer. This kind of cohort is being added to. There are more coins joining this group, and essentially what that means is that people who had a Bitcoin, maybe they acquired it back here, a year ago, a lot of people just haven't decided to sell that yet. They haven't decided it's worth selling it yet. They're holding, these coins that had been acquired about a year ago. A lot of them are being held. We're adding to that cohort. Those coins aren't being spent to the same degree that they're being held, and that's a positive sign. That's what we like to see, because that suggests that we're not in one of these really risky zones. When we see this decline in these old coins, that tends to be these points before a big bear market follows. The fact that we're actually seeing and adding to this kind of group of coins might be a positive sign that we're not quite entering a bearish phase. Now again, that's just current behavior. Who knows what will happen if there will be a capitulation that would drop this value. But right now, that's not looking bad from this on-chain perspective. Another on-chain model that we can look at is reserve risk. And this one's a little bit more complicated how it's calculated, but essentially what it's looking at is just long-term holders' confidence in the market as it relates to price. And the idea is that if long-term holders are losing confidence and the price is really high, they're probably just going to be selling. And then the idea is that long-term holders probably are a little bit more knowledgeable about the market in general. That tends to historically be the case. And so if they're losing confidence and they're distributing their coins, that tends to denote these tops that can then lead into these bear markets. And so you'll see that in these past, tops for Bitcoin, the reserve risk gets up into this red band, and we really just haven't seen that. It increased as we went into, late winter, early spring in 2021, but now it's just been kind of hanging out at this lower range, not in the green zone. That's generally denoted these really kind of spectacular accumulation zones, but it's not, it's not anywhere near the red zone. And one thing I think is also kind of notable what's going on right now is, the price of Bitcoin has been increasing with time, and generally with reserve risk, as price goes up, the reserve risk will move up as well. We're actually seeing this interesting phenomenon right now where reserve risk has been remaining steady even as price goes up. And what that might mean is that long-term holders' confidence in the market is not decreasing as price is going up. They're still expecting more and more upside. They're not just getting out of the market right now. And that, again, would be bullish. It suggests that long-term holders might have more kind of positive sentiment. They might be maintaining their bullish sentiment about the market, not trying to exit, expecting higher prices to come. That's good. When you see long-term holders capitulating, really distributing and selling off everything, that tends to be bad. That tends to be when bear markets can follow. We're just not really seeing that yet. Now, again, anything could happen. Long-term holder sentiment could change, but currently we're not really seeing any of that unfold. So these are just some on-chain metrics, but really across the board, generally the picture with on-chain data, I mean, some people criticize on-chain data just because it does tend to look so bullish, but I would argue that's not always the case, because clearly, going into bear markets, there's bearish things that will show up on on-chain data. And what we've been seeing with on-chain data just generally is pretty much largely just bullish things ever since the summer. Long-term holders are not distributing. The balance of coins on exchanges has been continually falling. There's not really a whole lot on chain to be worrying that's especially concerning right now. There's a few things that different people can pick at that don't look great, but on the whole, in my opinion, the on-chain picture still looks pretty healthy. There's not anything that's screaming that a bear market is imminent, which is, of course, a good sign. Now, that's just my interpretation, my reading. You should make your own opinion, but that's just my perspective. So really what this all goes to say is that in my own personal view, there's nothing really internal to crypto or to Bitcoin or really the crypto markets that suggests that we have to be going into a bear market soon. We're just not really seeing any of the telltale signs that that's imminent. Risk is not at a super high level right now. In fact, it's in the green zone. Momentum bias is not just hanging out in the negatives like we've seen in past bear markets. And with some of these on-chain metrics, we're also seeing positive signs. And with market sentiment, that for a more short-term kind of idea, we might be nearing a bottoming point with the current price of Bitcoin. So if there's nothing internal to crypto to be especially concerning, what other things might we want to watch for that could affect the crypto markets that are kind of outside of the crypto market that it has no control over? And so there's a couple of ones that I want to talk about that I think are useful. So one of the things that I think is useful is just to keep an eye on the stock market. My general thesis here is that a bullish stock market will mean a bullish crypto market. And the reason I say that is it really seems like crypto has been treated as kind of this risk-on asset more recently. As more and more institutions come in, people who are kind of more from the traditional finance world who might just view crypto as being this kind of risk asset, they aren't from the perspective of a lot of the kind of Bitcoin natives or kind of the early adopters who see Bitcoin more as this kind of alternative monetary system. People who are coming in from these financial institutions might see it more as just a risky investment to kind of increase profit during risk-on times, but something to avoid during kind of risk-off times where the markets generally are getting kind of worried or not doing so well. And because of that kind of potential correlation between the stock market and the crypto markets right now, I think keeping an eye on the stock market is useful. It's something that's easy to keep in mind. So I want to talk about next then is what are some things to think about in terms of the health of the stock market. Just some things to keep an eye on. And now obviously there's 8 bajillion different things that go into the stock market, so I'm not going to be able to cover everything, and frankly I don't think anyone really can predict what's going to happen with the stock market. I'm just going to talk about a couple things that I'm keeping an eye on that I think are some interesting things that might play out over 2022 and something to keep an eye on. So the first thing I'm showing you here related to the stock market is actually our risk indicator for the S&P 500, the stock market, basically, one index that tracks the stock market. So again, red, high risk, green, low risk, and this is the monthly time frame for the stock market. So starting all the way back in the early 40s, all the way up until now. And there are a couple of interesting things to observe from this chart, right? So the first thing you'll probably notice is we are re-entering the red zone, so that's not spectacular. That says that the stock market overall is high risk. But really what is important to note is that when we see these red periods emerge in the past, there's kind of 2 different things that have happened in the past when we've entered this. The one kind of behavior we've seen in the stock market back in the 50s and 60s is that every time the stock market entered these red zones, there was kind of a correction, kind of these bunny hills where they would go into the red zone, have a bit of a correction, the red zone, a bit of a correction, but then ultimately staying in an uptrend. It played out over many years, but it was still an ultimate kind of uptrend. And overall, bull market, even though there were years in there where the stock market didn't do so hot, had either relatively steep corrections or kind of sideways movement before moving on. But then the other kind of scenario when we've hit these red zone in the past is what we saw in the mid to late 1990s and into early 2000s, where we just went on this crazy bull run. We just went on this crazy run. We sustained these really high risk levels for years, in fact, before we had this very deep correction in the market, and kind of what ultimately led into more or less sideways kind of accumulation zone until all the way after the Great Recession in 2008, before we were finally able to then move back up to all-time highs. And then now we've had this pretty steady bull run that's now led us up into this high-risk zone. Again, not totally dissimilar from what we saw going from the early 90s up into 2000. And so from that perspective, what you might argue is, okay, maybe we're nearing, maybe the end of this bull run is going to come, where there's less of this bull run to come than has already happened, one way of thinking of it. But it doesn't necessarily mean we have to have a correction immediately, right? We've seen before the market sustain these crazy high risk levels for years. So that could happen again. So there's no reason to think that we have to have a correction in 2022 necessarily. Although if we do something more like what we did back here, then it might mean that a correction might be likely. And so really what I want to say here is certainly it's not great to be at these high risk levels. Obviously we'd be rather be at these lower risk levels to be able to be much more confident about a sustained move to the upside. But that being said, it's not to say that within the next year we have to see a crash by any means. So we've seen before being able to sustain this for years, half a decade or more. Whereas back here, it led to more corrections. So let's have to wait and see what happens. It's possible there'll be a pullback in the stock market and things won't do so well in 2022. If that were to happen, I wouldn't expect crypto to be doing especially well in 2022 necessarily, as long as that correlation, that kind of seeing of crypto as being a risk-on asset maintains. Obviously, people provide counter arguments where they say that crypto shouldn't be correlated with the stock market and that there's reasons why it shouldn't be. That's kind of beyond what I'm talking about here. Really, I'm just saying that there's kind of been this idea more recently of crypto being a risk-on asset. So assuming that doesn't change, I would think it wouldn't do so well if we see a correction here. But time will tell. But again, I don't think we have to see a correction in 2022. And so really, to say that that has to happen, I think is premature. We'll have to wait and see. And certainly if we just look at recent price action of the S&P 500, there's nothing going on right now that even says that we're necessarily at the beginning of any kind of correction. The 50-day moving average, this white line here, has been this kind of support line for the bull run ever since, this is going back to, May, July of last year, going up through this year. You'll see it's just kind of constantly bouncing off, or every time it's dipped below, quickly got back above, and it's been doing that recently. And we recently, just in the last few days, had another all-time high on the S&P 500. So currently, there's nothing going on with this that says the market is currently in the process of dumping. Now, who knows what's going to happen in the coming days and months and weeks, but currently, as I record, New Year's Eve 2021, we're not seeing any kind of a crash right now. Now, there are a couple of other narratives that I think are important to keep in mind, kind of on the macro scale, things that could affect the stock market that have been talked about that I want to bring up here as well. So, obviously, one of the big stories in kind of recent months has been inflation, kind of coming into this point after all of this, the supply shortage issues that have come out from the pandemic, and then all the stimulus, all the extra money that's been entering into the supply. We've seen this kind of uptick in inflation that's gotten a lot of people concerned. And in fact, one of the things that the consequences of this high inflation that hasn't been kind of transitory, as some people were arguing at the beginning, that it would just very quickly fade, and that was all just due to these kind of supply disruptions in the pandemic. Because the supply chain disruptions have maintained, and because of these other factors with money supply, etc., and high demand, these have been this inflation has been persisting, and one of the consequences of that has been that the Fed in the United States is going to be dialing back its quantitative easing, its basically stimulus into the economy, the amount of support that it's giving to the economy. And generally speaking, when the Fed will dial back those and then eventually raise interest rates, which is what's going to be coming, at least that's what they say will be coming in 2022, 3 different rate hikes across the year. Normally people see this as not a great thing for the stock market. The idea being that generally speaking, when the Fed dials back, its bond purchases, and then especially when it raises interest rates, that means that debt becomes more expensive. It's harder for companies just to take out on a lot of debt to fund their growth. And so that means that growth might slow down. That might mean then that stock prices will falter, or maybe there will be a correction in the stock market. All those kind of things that people look at to say that this is, it's not always ideal. And so the Fed has to walk a fine line when they're trying to make these changes, because if they do it too harshly or too quickly, they could set off a correction in the stock market, or at worst, even a recession if they do it too aggressively. Now, that being said, a lot of people have argued that these have actually already been kind of priced into the stock market. And there's actually some data showing that even when the Fed does raise interest rates, the stock market doesn't always just immediately correct. In fact, it can actually continue growing for quite a while after that before it might start seeing a slowdown. So there's nothing to say that immediately when this happens in 2022, we'd have to see a pullback, or even to say that would have to happen in 2022 itself. But certainly, rate hikes are more concerning than no rate hikes in terms of the stock market appreciating. Now, obviously, the Fed feels this is necessary to combat inflation, so there's that element of it as well. And runaway inflation is not good for an economy. But in the short term, this can lead to some bearish sentiment for the stocks. Although there's some people who are arguing that with the recent Omicron variant, that the idea that the Fed is going to be able to kind of take a harder line and actually increase it, make its monetary policy harsher or increase rates might be less likely, just because if Omicron does end up disrupting supply chains even worse, that's an issue on the supply side. The monetary policy is more about affecting things on the demand side. Then the Fed's going to have to be especially careful if Omicron is really messing up supply chains. They're not going to be wanting to do anything to slow down the economy if that's already under a strain from a supply side. And so we're just going to have to wait and see what happens. So I'm just showing a tweet here from Toshka Labs, who is a great commentator on crypto markets, but she also comments on more macro things. And basically the point of this tweet here is that with Omicron going nuts, not just in the United States, but probably the rest of the world, if that leads to more disruptions in supply chains, that might mean that the Fed has to be especially careful about tightening its monetary policy for risk of sparking some kind of a recession, where you have prices going through the roof because of supply shortages, but then also people having less disposable income to put around due to lessening stock markets or a slowing economy and less jobs, worse unemployment, all those kind of things that would come with an economy that's not growing as well as it could be. So there are also other things to consider in this narrative about inflation and how problematic inflation really could be for the economy if it's allowed to run rampant. So if this does happen, where the the Fed isn't really able to kind of try to do what it can to curb inflation, and inflation continues to run hot, is that really a problem for the economy? I think the kind of lay intuition, or the kind of the common wisdom, is that yes, inflation is always going to be bad for the economy. But there actually have been historical times, at least in the United States, where inflation has run hot, but in fact it hasn't really been that huge of a problem. And really what, in that time, the one that people point to a lot is coming out of World War II. The U.S. had, the inflation in the United States was quite high. The United States had taken on a lot of debt to fight the war. And so we kind of came out of the war in this period of high inflation, but there's also really high just economic growth. Coming out of World War II, the United States had really, it had geared up its economy for the war. And then when the war ended, with the rest of the kind of world economies being devastated by the war, the U.S. was able to do especially well, and the U.S. really boomed out of that period. And so really economic growth was so high that inflation didn't end up being all that problematic. We're kind of able to outgrow the inflation to some degree, or at least that's one of the arguments, or at least my understanding of the argument that people put forward of how that all played out. And so we had a period of high inflation, but it wasn't really a problem because we were able to grow so quickly out of that. And so one of the things that you could look at this for, if the Fed currently allows inflation to kind of run hot, or doesn't do what it can to curb it at the very least, it's questionable if they have full control over inflation given the supply issues right now. But really what we'd like to see right now is growth in the economy then. And so one of the things that isn't great to see is economic growth slowing down as, consumer spending has been decreasing. And of course, this is all tied back into the pandemic, of course. Consumer spending took a massive hit during the pandemic, not just for, economic, kind of concerns, but also because people just didn't want to get sick. They were staying home. They weren't spending as much money out in the broader economy or in all the different sectors they normally would be doing, not traveling, things like that. And so if Omicron, leads to that kind of behavior again, that might not be great for the short term. And so to zoom out a little bit more, though, really what we're seeing right now in terms of growth, it's not, we see these outliers, going into the pandemic, huge drops in growth makes sense, had a huge stock market correction, a lot of people got laid off. But then we saw a very fast rebound, right in the next quarter. And we've been holding fairly decent, growth rates since then, actually even a bit above what we've been seeing pre-pandemic. And so really, if we can see this start to increase, and if Omicron isn't as long-lived as some fear, there's some evidence from South Africa that the Omicron wave there is already receding, South Africa being kind of the first epicenter. And if that happens elsewhere, then maybe the Omicron wave will not be as disruptive as some people think it could be, and then growth won't be as negatively affected as it could be going from that. We'll just have to wait and see what happens with that. But if we see high economic growth coming out of this, then even if inflation runs hot, it might not be especially concerning. It might not be what is really feared with inflation is this idea of stagflation, if you've heard that concept, which really happened in the 70s, where there's very little economic growth but really high inflation. And when that happens, it's obviously not going to be great. Wages are not going to be keeping up with inflation. People's purchasing power is going to be dropping. It's really not a good place for the economy to be. And that's where the Fed ended up had to be incredibly aggressive to curb down inflation, and kind of brought about a recession just to be able to fight inflation. And that's what really people are, I think, most concerned about with inflation right now, is that the Fed might have to do something so extreme that would bring about a recession. And then obviously that's not good for any asset, stock market, crypto, nothing's going to be super happy at the beginning of a recession or anything like that. But we'll just have to keep an eye. And so I just did want to bring forward this perspective about growth, because I think people usually just think about inflation in this binary terms, that high inflation is always going to be a disaster. But there have been times in the past where we've been able to maintain high inflation with when it went along with high economic growth. Now, again, I'm not an economist. I'm obviously way oversimplifying all those different arguments, but that's kind of the general landscape of those dynamics as I understand them. And one of the things I do just want to mention in closing from this idea of growth and inflation, all those things, I'm just this is kind of an argument that's been put forward. Kathy Wood is one of the people who's been arguing for this. This idea that, since we're not in World War II, coming out of World War II right now, there's not, we're not in a situation where the U.S., for example, is the only, economy that didn't get devastated by a war. The idea is, what could be driving high GDP growth that would help us offset concerns about inflation, like what ended up happening out of World War II. And one of the arguments that Kathy Wood puts out she's from ARK, investments, an ETF that did extremely well coming out of the pandemic, although not quite so well right now. She tends to invest very heavily in technology sectors. So she invested very heavily in Tesla, for example. And her argument is that technology is actually going to be the catalyst for high GDP growth, and that's not necessarily being understood yet in the markets. And so from her perspective, GDP growth might be able to really boom in the next years and decades on the back of technological innovation. Now, who knows if that's actually going to happen, right? Who knows if technology is really going to be able to put everything on its back and carry us forward like that. But that's one argument that's been put forward about how we might be able to see high GDP growth. And if that's the case, then maybe this high inflation wouldn't be as concerning as it could be if we were in a more of a stagflation environment where there was no or very little GDP growth but high inflation. We'll just have to wait and see what happens, obviously. But I just want to put this out here as one argument about one thing that could catalyze some higher growth in the coming quarters. Okay, so that's talking about the stock market. And again, my idea there is that if we want to see a healthy stock market, to see, more likely than not, a healthy stock market would help crypto also be healthy. One of the other things that I want to talk about, which is a little bit more specific to crypto, a little bit more short-sighted or short-term, but I think also important and an interesting thing one to think about, is the idea of retail investors and whether or not they've been in the market and what might lead them to come out. What's going on? Because really the idea is that with these kind of blow-off tops we've seen in the past for Bitcoin or for the crypto market, oftentimes, that's been fueled by this kind of FOMO of retail investors, where crypto or Bitcoin starts going on a run, or the rest of the crypto market starts going parabolic. A bunch of people don't want to be left out, so they all jump in, they all dump money in, and you see the valuations just get absolutely extreme, go into the extreme bubble territory to a point where it's completely unsustainable, and then you have those blow-off tops where there's just no buyers to come in anymore, and then we go into those protracted bear markets until all that cools off. A lot of those retailers leave crypto. They don't want to stay. They don't stay for that long, and then they come right back into FOMO in for the next peak. But really, the thing I want to talk about is that a lot of people. So I'm showing you a tweet from Will Clemente, who's a great on-chain analyst. I recommend following him on Twitter if you don't already. But one of the things that's been coming out, or I've been seeing more and more on crypto Twitter, is this conversation that's been ongoing ever since kind of the summer. This idea that retail investors aren't really there right now in the crypto market, or at least in Bitcoin. So don't worry too much about these. These graphs are all just showing different metrics that suggest that. This is transaction fees on the Bitcoin network, which you can see are really low right now relative to where they had been back in the spring. These are transaction volumes by a kind of lower USD amounts, and then this is volume by higher amounts. And really what Will is arguing here is that in terms of activity on the Bitcoin blockchain, most of it's being dominated by big players who are moving around large sums of money. It's not being really driven by smaller actors who have less money to move around, suggesting maybe that retail investors aren't really interested. They're not really in the market right now, or at least way fewer than had been at the beginning of the year. And Raoul Pal, another commenter on the crypto markets, generally talks about more kind of macro ideas, made a similar observation that retail doesn't seem to really be here right now. And one of the arguments that he leveraged for maybe why this is this idea of inflation. That's what he refers to here by the CPI, Consumer Price Index. It's an indicator basically of inflation. And he's basically arguing that because inflation has been increasing, people might have less purchasing power, less free money to throw around, so maybe they're just not entering into an asset like crypto because they just don't have the money to do so. And he also had shared a graph of the total wallet addresses, and this is a logarithmic chart here. We're just showing that really dumped after the spring, and it hasn't really recovered from there. And so if that's the case, let's talk a little bit more about his argument, though. I want to talk more about this idea of inflation being something that might be leading to this cooling off of retail interest just because of a lack of funds. And certainly, it's inarguable that inflation has happened and that it has been notable. So here, the U.S. Bureau of Labor Statistics has a calculator actually you can use where you can just go in and look at the buying power of $100 at some point in the past, and how much money you need now to have the same buying power as that amount back then. And so the idea here is that $100 in April of 2021 would actually now be worth $104 adjusting for inflation. Or another way of putting this is you now need 4% more dollars to equal your buying power just back in April of this year, not long ago at all, 8 months ago. And so certainly that's not nothing, right? A 4%, needing 4% more money now to have the same buying power you needed back then is nothing to scoff at, especially with, in less than a year this has happened. And so really from Raoul Pal's argument, he's basically arguing that this has restricted the retail investors' kind of free money to invest, and that they're not putting the money into crypto. They just have, because all the dollars they have less buying power than they did just 8 months ago. They might be unwilling to put them into the crypto markets. So that's possible. It's possible that people just don't feel like they have the extra money, and they or literally don't have the extra money because their buying power is decreased, and that's why they're not doing it. And there's other data that we can look at that might point to this as well. So this is just a headline from Business Insider. There was a survey, this is back from September, but found that 60% of millennials who are earning over 100,000 said they were living paycheck to paycheck. And if you dive more deeply into that survey, this is just kind of one thing that they pulled out for this article. But actually the survey, they found that overall 54% of all Americans live to paycheck, meaning that they don't have a lot of extra money that they're saving. They're spending money as quickly as they're earning it, basically. And 40% of high earners even are living paycheck to paycheck is the idea. And that's interesting. It's a little bit, it goes along with what Raoul Pal was arguing. If you kind of pair this with inflation, the idea is that people were already spending as much as they were bringing in. They don't really have a lot of extra disposable income maybe, and so they maybe not be willing to put that into an asset that they might see as risky, like crypto, and that might be keeping them on the sideline, at least for now. But that being said, there's a counterpoint that I want to bring up that I think is important. And that is that I don't think it's totally reasonable necessarily to argue that just because we know that a lot of people are living paycheck to paycheck, or just we know that inflation is rising and so people's purchasing powers are lowering, that's not necessarily guaranteeing that people are going to avoid risk, right? Or that people are gonna stop shooting for the moon or stop chasing some really high yield. And I think nowhere better can we look to show this than just people's participation in lotteries. So, of course, lotteries, where you buy lottery tickets, you have a very, very small chance of winning some large amount of money. The expected value is quite poor. You're going to be doing better off of that money just investing it elsewhere. Crypto is going to give you better expected value than the lottery. But that doesn't stop people from putting in, in the United States, $100 billion in into lotteries. So this is from LaFleur, is basically a trade magazine for the lottery industry, and what they put out for their findings for 2021, or their projections, their estimates, is that total lottery sales have been around a little less than $100 billion. And I think this is kind of remarkable because we also know that people who play the lottery, people who buy lottery tickets, tend not to be the people who could afford it the most. They tend to actually be lower income individuals. So this is a little bit old article from 2018, but what this survey had found was that that 28% of Americans who earn less than $30,000 a year, so not a whole lot, end up spending $412 a year on tickets. They play the lottery at least once a week. And so that's, I think, kind of remarkable, right? Because this is, by definition, an incredibly high risk thing. In fact, your expected value, you're basically just expecting to throw money away with the lottery. It's quite a poor return on investment. There's a reason why investors aren't just buying lottery tickets, because they know that they're going to do better elsewhere. That's why they're not investing. Now, that's not if you buy lottery tickets, more power to you. I'm not trying to throw shade or anything. It's just that I think it's indisputable from statistical perspective that the lottery is not a great return on investment, generally speaking. But yet people still do it, and in fact, people do it who really are low income, who are probably already living paycheck to paycheck. They make room in their budgets for this really high risk thing. So to argue, in my opinion, to argue that people are not going to maybe enter a risky asset just because they don't have a lot of money doesn't really seem to hold water, because we already see people doing this. And in fact, in an asset that has worse risk-reward ratio to it than something like crypto would. So to think that just inflation or just living paycheck to paycheck would necessarily keep people out of the market, I think is not necessarily reasonable. It could be, certainly, it could be one of the things, but I think that it would necessarily keep people out, I think, is a little bit premature, given that we already know that people will throw money at really high risk things with really low chances of returns already. And you can imagine, if this $100 billion were to be pumped into the crypto markets, that would be meaningful. It wouldn't be excessive, but it would be meaningful, and it could certainly be a big shot in the arm of crypto if even just a slice of this were to come in some of the early months of 2022, for example. And so maybe it would just mean that more kind of average Americans or just average kind of people in the world stage would have to see crypto as being kind of an alternative kind of high yield asset that might take precedent over some of these other high risk opportunities they're already taking advantage of. If crypto could start supplanting some of that risk on appetite that people have, even people who don't really have a lot of disposable income to throw around, that could be a tailwind. And also there's another dynamic to crypto that we're seeing play out in inflationary environments as well. That's kind of a counterpoint maybe to saying that inflation will necessarily lead people to not be investing in crypto as heavily. And that is just when inflation gets too extreme, which is actually what we're seeing right now in Turkey with the Turkish lira. So this chart I'm showing you here is just pulled off a trading view. This is the lira against the US dollar. And you'll see what's happened since September is just fallen off a cliff. Inflation has been to the order of 20%, up to 20% in Turkey has been quite bad, and people, obviously people in Turkey have been suffering as that, losing that much buying power that quickly is not going to go well, kind of wipe out the value of your savings quite quickly. And so one of the dynamics that's actually been unfolding in Turkey has been that people have actually been looking to crypto as one way to kind of hedge against inflation, that, the lira is losing value so quickly that in fact going into crypto is being seen as a valuable thing. And now what exactly they're going into might depend, it might kind of vary, but just the fact that there's more interest in crypto from just average people in Turkey might suggest that at the extremes of inflation, it could actually lead people into crypto instead of just necessarily keeping them out always. Now, again, this is an extreme example with a very high inflation rate, which the US and a lot of other world economies haven't really gotten close to yet, but it is just something that I think is a useful data point when we consider it. And I think when we also think about this in interaction with the fact that cryptocurrency is becoming increasingly mainstream, there are more and more on-ramps that are being built. It's now easier to buy crypto. It's easier to buy crypto now than it's pretty much ever been. Venmo, for example, PayPal have already made it possible to just buy crypto directly in that, and millions of people already use those platforms. Things like Coinbase or other Gemini, other just cryptocurrency exchanges have been are very easy to access and provide a lot of readily available crypto to buy. And so really the idea here is that if we do suddenly see an increase in retail interest, it's now easier than it's ever been for people to go in and enter the market. And so if inflation isn't really this thing that's going to prevent entrance by retail investors, essentially the argument I want to make here is I don't think there's any reason to think that retail investors can't re-enter and that they can't do so in large scale. Even with the backdrop of inflation, I think it's still possible that we could see a big retail rush, especially if crypto starts really getting into the news or starts really generating high returns. People might see it as a more favorable place to be placing their high risk bets rather than other things that they might have been turning to in the past, or especially something like the lottery, which is just extremely high risk. And if crypto is seen as another way of making exorbitant amounts of money, and not just kind of throwing away your money, maybe people will start redirecting their disposable high risk cash into something like crypto. And we've been seeing this kind of across the crypto market. And obviously we've also been seeing other adoptions. So for example, Square changed its name to Block, Facebook changed its name to Meta, all these things kind of revolving around blockchain. I think it's safe to say that the mainstream of crypto is starting, and if that increases in 2022, that could be another thing that drives more retail investors in. People who might have been skeptical of crypto or not known much about it might just see more about it and then decide to dip their toes into the water, and that could then lead to a resurgence in retail capital. So to summarize, what I'm saying here is just for these three things I'm talking about, obviously there's going to be a lot more that feeds into whether or not crypto will be bullish in 2022. But just from the things I've been talking about in this video, some things that I personally will want to see happen in 2022 for it to be bullish is I want to see, obviously, the crypto markets stay healthy, kind of on an on-chain basis, you know, not see capitulations by long-term holders, see long-term holders continue to add to their stacks, etc. You know, maintain of good technical structure. You know, we're still in a technical uptrend. That's great. Would love to see that continue. But then also pairing that with some other bigger macro trends would also be useful or be helpful. So a healthy stock market, you know, not seeing a correction would be great. And so, you know, we just saw the stock market is in a risky zone right now, but that doesn't mean it has to correct in 2022. And so really, we just hope that the music continues to play in the stock market for the next year. And if it does, that, in my opinion, means that there's nothing from the stock market angle that will be dragging crypto down. And then finally, kind of this last piece is I would like to see a renewed interest by retail investors as we get into the year. You know, currently right now, what different folks have been arguing, you know, Will Clemente or Raul Paul, is that it's really, you know, the big players who are driving price action right now. And so from that perspective, we'd be kind of at the mercy of institutions or other whales who are really getting more invested in crypto for price to go up. Whereas if retail investors start to arrive more on the scene, then we're less beholden to what kind of the whims of those big players. That, you know, retail investors is not something that they can, you know, directly control, although some argue that they would try to manipulate retail investors. But at least there'd be this other source of money that we're not just all fully beholden to what institutions are doing in the space. And so personally, I just, you know, my opinion is just the more adoption we see across the board, both in institutions and in retail, the better. And if we're not seeing retailers come into the space, that would be concerning. Because really, that's something that we've always seen going into those kind of big parabolic moves to the upside. Not to say that we'd have to see it again necessarily, but certainly I would be concerned if we don't see more interest start to pick up in 2022. All right, so those are just a few macro things that I've been thinking about. Again, I'm not trying to argue that this is everything or this is all inclusive, and certainly I've oversimplified certain things. So, you know, take some of what I've said with a grain of salt, you know, do your own research if there are very specific things that you're interested in. But this is just my broad view of where we stand with the markets today from a macro perspective, both within and outside of crypto. And we'll have to wait and see. With any luck, we'll have a bullish 2020 and maybe even have a nice blow off top to cash out on. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, we're all going to make it.